Howdy, folks. Welcome to the January 2025 monthly market wrap up, your no nonsense recap of everything that shook up the financial world last month, from record breaking market moves to corporate layoffs and regulatory curveballs. We'll break it all down with just the right amount of sarcasm, because you know me, to keep things interesting. So grab your coffee or something stronger, and we'll dive into what happened in January with your money. So, all right. Well, this is the first time I'm doing this. So I hope everyone enjoys this. This is going out just to clients for the first week, and then I'll open it up for everybody else to see on YouTube's and stuff like that. So this is private for the first 7 days, and then you're welcome to share it with anyone you want. You can share the link to friends, family, or whatever. So, all right, well, let's dive into what happened last month in January. So let's get started with the returns. Looks like everything had a positive return as far as the major indexes. The MSCI total return, I think, is the overseas, was up 5.26%. The Dow Jones was up 4.78. The Russell 1000 up 3.18% last month. S&P 500 up 2.78. The Russell 2000 up 2.62. See, emerging markets up 1.81, and the NASDAQ was up 1.66, which is not generally unsurprising due to the fact that the growth side of the market was certainly not as good as the the value side of the market last month. So moving on, looking at the asset classes so far year to date, everything is in the green or in the positive if you look at it here. And then we go to a 1 year. Let's see, U.S. growth is the highest at 32.7%. And let's see, value came in at 19.5. Let's just hit some of the commodities came in at 8%. And then some of the bonds came in at the bottom. Munis at 2.1, aggregate bonds also at 2.1, and U.S. Treasuries at 1.4 on a 1 year basis. All right, well, diving into the economic data for the month, unemployment came in, or I'm sorry, the unemployment rate came in at 4.1%, so not too terrible there. Unemployed Americans are currently at 161,661,661 at the time. So again, this has kind of flattened out over the last year or so. So I'm, this could be just a kind of a confluence of several things. The boomer generation retiring, smaller, the Gen X in my generation is much smaller. And, the kids in the workforce in Gen Z or Y and Z are just entering the work. Well, I guess Gen Y has already been in the workforce. All right. Labor participation rate is at 62.5. It's been, kind of in this middling range for quite a while. Granted, the longer trend has been trending down for a couple decades. Initial jobless claims currently are sitting at 219,000. This was as of the last reporting week in January. And continuing jobless claims are currently at about 1.88 million. Again, looking at the chart, it's fairly flat. We have not seen this to start to tick up. And, as I've told people over the last year, I wouldn't really put a whole lot of stock into the jobs numbers currently right now, simply because they are more of a lagging indicator. I would pay more closer attention to spending. Consumer spending, the next one up here. Currently, we are still trending in that northeastern direction on the XY axis, and we currently were at is that 16.28 trillion is what it looks like. So again, still pretty good there. Inflation is still, much higher than what the Federal Reserve would like. It's currently coming in at 2.9%. Certainly down from where we were 2 years ago, but still not back to where we've been trending the last decade or so. Energy inflation is down by 3.6% year on year. So again, pretty good. Hasn't really seen a lot of difference at the pump for me here in Colorado, but this certainly should help out those for gas or the natural gas and such that we use a lot more of during the wintertime. WTI, West Texas Intermediate, is currently trading at 70.5 a barrel as of yesterday. So again, down from where we had been a few months ago. Certainly, I mean, I'd love to see $40 oil, but with the massive increase in other commodities like gold and silver, oil is actually probably cheaper than we think. It's just that the dollar's been devalued greatly over the last 4 or 5 years. The Federal Reserve, the money supply is currently sitting at $21.533 trillion. It has been trending back up again of late, and which again, when the money supply increases, that is a sign of inflation. So I'd like to, you know, in a perfect world, we'd like to see where where this trend line was originally going and try to match back up with that. But I don't have a lot of faith in the Fed doing that at this time. Total assets that the Fed has on its books, $6.8 trillion currently right now. Again, still trending in a downward direction is what we'd like to see. We'll see what happens the next time we have a recession or a black swan event and see what the Fed does there. The Fed funds effective rate is currently between 5.25 to 5.5. We can see where the Fed raised rates a couple of years ago, held steady for a while, and then dropped rates by 100 basis points or 1% last year. So this is where we're currently sitting. I know a lot of people out there in the economy and the markets would like to see the Fed funds rate continue to trend downward, especially if you're trying to get a mortgage, things like that. However, with inflation as sticky as it is, I wouldn't hold my breath because unless something negative really happens, I wouldn't expect it to occur. The yield curve has finally normalized again. It's actually pretty flat, but normally you'd like the curve to kind of go like this, uh, you know. But right now it is still fairly flat, even though it's still considered normal. And then this chart, the 10-year Treasury constant maturity minus the federal funds rate, has finally popped back up into positive territory after being inverted. What this chart basically shows is that anytime the yield curve inverts, it goes below this midpoint, which we were inverted for 2 years, it seemed like. So I would expect a recession or bear market somewhere in our future, simply because anytime we do dip below this, we do typically have some negative consequences after the fact. Household net worth is still trending in a positive direction. It did, pull back a little bit uh, during 2022, but has been trending back in an upward trend. And GDP growth came in for the fourth quarter on the first number, came in at 2.3%, down from the 3.1 in Q3, but not unexpected and still, pretty good there. And the trade balance is still at 98.4 billion in the red, so not fantastic, not as bad as it was in 22, but still not great. And government debt is sitting at about 36 trillion and change. I don't, we haven't seen this really start slow down in some time, and obviously it jumped quite a bit during the whole COVID stuff a few years ago, and has continued to trend upwards. To me, this is our biggest problem. Yeah, people are fighting in Washington over who's in control of who, but all the while we're running ourselves into insolvency. So, to me, this is the biggest problem. If we could slash government spending by 50% and throw a trillion or two at the debt, every year until we pay it off, that would be my solution. But hey, I'm a financial planner, so that's just how I think. All right, and wrapping things up, upcoming regulatory news. Let me get my notes up here. I'll shrink that down. Where's my notes? All right. So number one, proposed closure of the carried interest tax loophole. President Trump has announced intentions to eliminate the carried interest tax loophole, which currently allows private equity and hedge fund managers to pay lower capital gains rates, capital gains tax rates on their earnings. This move aims to increase tax revenue and address perceived inequities in the tax system. If enacted, it could significantly affect investment strategies within private equity and hedge fund sectors. Again, I have no problem with that. I mean, I personally would like to see just a flat tax, just across the board, whether or not it's a flat income tax or a flat consumption tax, like a VAT tax, like they have over in the EU. But this confusing tax system where we have all these employees and, you argue. I mean, I've been audited. It's, been close to 20 years, but it's a pain in the butt to have to drive. I mean, I was living in Las Vegas at the time and had to drive, downtown and to the IRS office and sit there and, explain. I think it had to do with like moving costs because we had moved a couple times within I think like 3 or 4 years. So, I mean, I had all the receipts, I had all my expense reports and everything, tallied up, and the lady looked at it and said, "All right, you're fine." And, but it was still an aggravation. I had to take a day off from work, go downtown. I mean, not that downtown Las Vegas is terrible, but anyways. All right. Next up, Federal Reserve's adjustments to bank stress tests. Let's see what's happening there. The Federal Reserve has proposed a less stringent stress test scenarios for banks in 2025 compared to the previous year. This adjustment suggests a more lenient regulatory environment, potentially allowing banks to allocate additional capital towards stock buybacks and dividends. Financial institutions should monitor these developments to understand their implications on capital planning and regulatory compliance. In this financial situation, or the world we see ourselves in, is having banks with uh you know well, regulations, sometimes are a bit overbearing, but is loosening your stress test regulations really the best thing to do? I don't know. All right. And then last, IRS enhancements for the 2025 tax filing season. The IRS has introduced new tools for services for the 2025 tax filing season, including voice bot assistance for taxpayers seeking refund information. These enhancements aim to streamline the filing process and improve taxpayer experience. Individuals and businesses should familiarize themselves with these tools to ensure a smooth and efficient tax filing season or process. All right. So that is everything. So, I mean, taxes, I usually use TurboTax for my personal taxes, and I have an accountant for my business. So, but are they going to make it easier? I know it's always a pain. I got to go through all my expenses and total everything up, and it's just, you know, pull in all of my brokerage accounts and everything like that. So it's a pain. So, all right. Well, that's everything that I was going to cover. So if anyone out there has questions, concerns, worries, or whatever, something I didn't address in this short video, feel free to reach out. Otherwise, I'll put another one out at the end of February. Also, it's financial planning season. So I'll probably be reaching out here relatively soon for clients to get your upcoming data and any changes that you might have had. So hope everyone has a great day, and I'll talk to everyone next time. Adios.